Hello, traders. Today, I want to talk to you about the three essential money management principles that every trader must know if you want to be successful. First of all, let me start off by quoting a very famous quote from George Soros. It's not whether you are right or wrong that's important, but how much money you make when you are right and how much money you lose when you are wrong. That's what it comes down to. That's all that matters. Traders, you cannot be a successful trader unless you learn how to manage your risk to reward. You absolutely must grasp and apply sound money management principles, otherwise you will fail. Period. Full stop. This is the business of trading that I'm talking about. First of all, professional traders measure their loss or profit in money terms, not pips. So firstly, do not worry about how many pips you've made or how many pips you've lost. It's how much money you made or how much money you lost. We are in the money business. So money management is exactly that, money management. It's more important to measure your risk on any particular trade in dollars, risk, not pips. This is where position sizing comes in. Position size is the amount of lots that you are going to trade, and the very first thing you need to do is determine how much money you are comfortable losing. What is your allocated risk amount per trade? The first essential principle is risk to reward. Then you need to determine your profit potential. Your take profit, in my view, should always be at least twice your loss. For example, if you're risking $50 per trade, your logical take profit should be at least $100. This is a risk to reward ratio of 1:2, meaning you can lose half your trades and still make money. So for example, over 10 trades risking $50, you lost 5 of them, you've lost $250. But you've made $500 on the next 5 trades, so you're in profit by $250. Now, of course, the numbers are better if your profit potential is greater than 2 times your risk, which is not uncommon. Now, professional traders understand the power of risk to reward. A lot of traders think they need to win all the time to make money. This is just absolutely not true. In fact, again, you can lose more than half of your trades and still be a very profitable trader if your risk to reward is accurate. So before you think about profit, you need to determine how much money you are happy to lose, because from there you can determine if there's a logical place on the chart for your profit, which is at least twice your risk amount. If it isn't there, then the trade's not on. In my view, under no circumstances should you place a trade where your trade profit is less than 2 times the risk that your risk amount. Guys, the best traders in the world only consistently win 50 to 60% of the time, but they continue to make money because they understand the importance of risk to reward. If the first step is to determine how much money you're prepared to lose, then how do you know what an acceptable risk amount is? Of course, every trade is different. No 2 traders are the same, and everybody's risk appetite is different. Some traders have a very aggressive trading personality. They are quite happy with their level of risk, which to other traders would seem like madness. On the other hand, there are traders who are unbelievably conservative. They hesitate when the trade is on, and their risk is so small, it will take a lifetime to make any sort of decent money. For me, I'm somewhere in the middle. If I see a trade setup that meets my trading plan, then I don't hesitate. I pull the trigger with full conviction, whilst at the same time being very risk adverse. So there is no one size fits all. A lot of trading programs are very rigid with their risk rules. Quite often, they will have a set amount in percentage terms. For example, it's not uncommon for a trading programs to promote risking a hard and fast, 2 to 2.5% of your trading capital. This may be what they do, but it may not sit well with you or anybody else. So here is the rule of thumb. To calculate a risk amount that you're happy to lose, you apply the sleep test. If you can go sleep at night and not be concerned or worried about the amount you have risked, then that's the amount that you should risk. You've probably hit the sweet spot. It's as if it doesn't matter if you lose, and you're going to lose. However, if you're lying awake thinking, I could lose this much, and your first thought is to get up and check on the markets, then your risk is too great. Dial it back to a level where you almost don't care about it. It's not going to rattle you emotionally. A lot of traders, in fact, most traders, trade with too much risk, far too much risk, because they are focused on the reward. So number one, you must always be focused on the risk. I cannot emphasize that enough. Now, depending on your trading capital, that will mean trading very small lot sizes, and people become impatient with that. They think it will take too long for their account to grow to any substantial size. This is a very unprofessional mindset, and these people soon learn the hard truths about risking too much money. It doesn't matter at all the size of your account size or how small your lot size is. What matters is that you are developing sound money management principles that will serve you well for the rest of your trading life. Don't be in a hurry to build your trading account up. It will come in due course, and of course by then you have a firm grasp on this most important trading principle, money management principle, which is principle number 2. You must always focus on the risk. You've heard me say that before. Let's just say you got $1,000 to trade with. Would you risk $100 per trade? Some people would. For me, I probably wouldn't. Why? Because you've only got 10 trades up your sleeve. Let's say you lose your first 5 trades. Not uncommon. No one likes it, but it happens. Then you now have only $500. Do you spend your time worrying that you've lost 50% of your capital? Well, the answer is probably yes. Then what do? Do you continue to trade or to risk $100, or do you now begin to risk less? The point is you now have indecision. You will be on a very unpleasant emotional roller coaster when that kicks in. Why do that? It's just silly. Instead, what if your risk was to say $50 per trade? Could you sleep well at night knowing you've got 20 trades up your sleeve instead of just 10 trades up your sleeve? Now, of course, these are just examples, but the point is you need to find a figure that you are comfortable with. And in my view, the best way to do that is whatever amount of money you're risking, if it doesn't keep you awake at night, then you've hit the sweet spot. If in doubt, always risk a lesser amount. You can always increase it as your skill levels increases, as your account grows. You're far better to do that than start off hard and then decrease how much you're going to risk because you've had a couple of losing trades in a row. One of the main reasons most traders don't last very long, and we all know this, and it's because they fail to keep their losses small. Money lost equals less money to trade with. Money lost, less money to trade with. Therefore, to make back those losses, you have to earn a substantially higher return. Why on earth would you put yourself in that position? That's not an easy thing to do. That only leads to revenge trading and other really poor trading decisions. You'll begin to trade outside of your trading plan, highly likely, in a feeble attempt to recoup your losses. Guys, that's gambling. That's not trading. Keep your losses small and have a predetermined stop loss, and whatever the outcome of the trade is, it is. Simple as that. And it should not rattle you if you lose a trade or a series of trades because your risk amount is on point. Principle number 3, be very consistent with your risk. It's easy to be tempted to increase your risk after you have strung together a few winning trades. It's a great space to be in. You begin to think you can't do any wrong. This is a major mistake new traders and not so new traders make. You must be very consistent with the size of your risk whilst you are developing your trading skills. Only after you have been consistently profitable, I'm saying for 3 months, can you then look at increasing your risk. Let's say perhaps you've doubled your trading account, then you may look to consider doubling your risk limit. Until then, be very consistent. Learn, make mistakes, learn from them, adjust and repeat. Now, you should be able to understand the power of risk to reward. If your focus is on taking only high probability trade setups, you should be able to make money over time if you are aiming for at least a 1 to 2 risk to reward. A skilled and experienced price action trader with a lot of patience to wait for only the most obvious setups should be, and is easily, able to win at least 50% of his or her trades. When you combine that with strong risk to reward, at least 1 to 2 or more per trade, you can easily see how the profits would start adding up. However, the key here is having patience. There may be only a few good setups per month. You may have to sit on your hands for a week. You may take 1 or 2 trades a week that lead to the big move. But that's really all you need. Even if your account is small, just worry about trading well. Don't worry about taking lots of trades per month. Just remember, guys, I implore you, being a skilled and profitable trader is the goal, not making a lot of money right away. The money will come to you as you become patient and disciplined and master your craft, which takes time. So now you know how much you're prepared to risk in a dollar amount. Apply the sleep test. You know where your stop loss should be placed, and you can see an obvious place on the chart to take your profit. So all that's left to do is determine your lot size. Your lot size is determined by, number 1, in order, how much money are you prepared to risk? You need to know your risk amount in dollar terms. Second, what is your stop loss placement? What's your stop loss placement in pips? If it happens that your stop loss is 100 pips away or 20 pips away, your lot size is in direct proportion to your stop loss placement. You simply alter your lot size depending on the stop loss placement so that you always stick to your allocated risk amount. And of course, the easiest way to do this is to simply download a lot size calculator. There's so many, you just punch in the variables, hit calculate, and that lot size calculator will tell you the correct lot size that you should be trading based upon your allocated risk amount and based upon the size of your stop loss placement. It's that simple, guys. Just find a lot size calculator that suits you. Now, guys, I know there's nothing new in this, but it's worth repeating. Most traders do not understand the business of trading. I implore you to develop and stick to sound, professional money management principles. If you can follow and implement what I've just shared with you, I'm telling you guys, you are way ahead of the curve and you have half won the battle. Hope you enjoyed this little video, guys. Talk to you soon. Bye for now.